How has your background in environmental science and your focus on sustainability influenced your investment philosophy?
If you're thinking about the next 5 years, you really want to understand the company from a fundamental perspective. And I think sustainability plays a large role in that. At the end of the day, it's just investing in companies that you think outperform over time.
There's such a big misconception that you're just giving up returns when you're looking at sustainability factors.
Where you have younger generations, Gen Z and millennials, really looking for more nutritious foods. That moves us away from those big food companies with heavily processed food. You really want to understand a company's business model, understand the industry in which they operate.
Do your homework, of course. I wanted to hear directly from you in terms of index funds versus active funds.
If you look at it again from an ownership mentality, it's really about the types of companies that you want to hold for the next 5+ years.
What can be done to promote more women in leadership roles?
Send that elevator back down so that they can rise to the top as well. Work hard, stay humble, and be kind. Maybe it's not a straight line, it's a bit of a zigzag, but it gets you to where you want to be.
Hello, and welcome to the Investing and Other Stories podcast. I'm Margarita Tr, your host and founder of Finance Latte, a leading investing education company. The information provided on this podcast is for informational purposes only. It should not be considered investment advice. Stay tuned for more important disclosures at the end of this episode. Our guest today is Amber Fairbanks. Amber is a co-portfolio manager of the IMPAX Global Social Leader Strategy at IMPAX Asset Management. Amber also researches stocks focusing on the consumer discretionary and staple sectors. Before joining IMPAX in 2023, Amber worked at Mirova, where she was co-portfolio manager of the Mirova International, US, and Global Sustainable Equity Funds. Prior to joining Mirova, Amber was a portfolio manager and analyst at Zevin Asset Management for over a decade. Amber received her MBA from Boston College and has a Bachelor's of Science in Environmental Science from the University of Massachusetts. Amber is a CFA charter holder. Amber, what an impressive career on sustainable investing. I'm so glad you're here, and a warm welcome to our podcast.
Thanks so much for having me. I'm excited to be here.
So let's get started. Amber, you studied environmental science before working in finance and getting your MBA. How has your background in environmental science and your focus on sustainability influenced your investment philosophy?
I think it's really about the ownership mentality. If you think about what it means to buy a stock, you're actually buying an ownership share of that company. People tend to forget that. So if you're thinking of yourself as an owner, you really want to think about longer term risks and opportunities. Today, especially, sustainability plays a large role in that. The world needs to become more sustainable. So companies that are creating products and services that help move the world to a more sustainable place should see economic tailwinds, whereas if you look at risks around ESG, they're quite material to a company financially. So understanding those becomes important if you have that ownership mentality. So I think my background in sustainability really positioned me to think like an owner and think about what was important from a longer term owner's perspective.
That's wonderful. And actually, that's a perspective you don't immediately think when you think about sustainability, like the owner perspective. So I'm glad you shared that with us.
Yeah, I think it's just at the end of the day, you can trade in and out of stocks, but I've never found anybody who's really good at making money doing that. I think the still exploitable area of the market is just having a differentiated time horizon. So many people are focused on the next quarter or even the next 6 months, but if you're thinking about the next 5 years, you really want to understand the company from a fundamental perspective, understand those risks and opportunities. And I think sustainability plays a large role in that.
Agreed. And can you please explain to our listeners, most of whom are outside the finance industry, how your social leader strategy falls within the sustainability space? Is it an ESG product? And ESG stands for environmental, social, and governance. Is it an impact product or something else?
I would say probably something else. So if you look at what we're looking to do in the social leader strategy, there's really 2 key tenets of the philosophy. It's the idea that the market's underestimating the growth opportunities coming from long-term secular trends that are shaping society. So things like aging population in developed countries, rising income for the bottom billions, even things like technological transitions and the need for those to be democratized. We really believe the market's underestimating growth opportunities coming from that. And the other key tenet is this idea around corporate culture, where I think it's kind of intuitive that when you have companies that have created great cultures that lead to motivated and productive workers and diverse influences on decision-making, lower turnover, we think those strongly outperform over time. But if you think about it, the market typically ignores culture in favor of more easily valued and understood metrics. So we've built this investment product that we think exploits these market inefficiencies to drive outperformance. So from a classic classification standpoint, it is classified under SFDR Article 9. So we have intentionality around impact. But at the end of the day, I think we are really looking to outperform the market by investing in companies creating positive social impact. And there's a lot of talk, especially in the US today, about impact and ESG. Not all of it positive, but I think it's intuitive and logical that when you have companies that create positive social impact, they're going to increase in value over time. Whereas when you have companies with really large negative externalities, for the sake of societies, these need to be innovated away over time. So we really see a strong link between companies creating positive impact and outperformance over time.
That's a wonderful perspective. So for those of us who are more pedantic about definitions, where would we find it? Under what classification would we find this product?
I would say it's an impact product at the end of the day. Okay. I've tried to move away from impact just because I think it's at the end of the day, when you're investing in public equities, it's about outperformance. So we label things impact or ESG, but at the end of the day, it's just investing in companies that you think outperform over time. So if you wanted to put this in a box, yes, it's an impact product, but we're using that as a way to outperform. If that makes sense.
It does. And thank you for giving us both the simplistic categorization and the more nuanced answer to that. Related to that, I saw that you co-authored a paper that scored companies' workplace culture and found that companies with strong cultures had superior results. I find that study fascinating because culture is just so hard to quantify. So can you tell us a little bit more about the study and what you found?
Yeah, it's really interesting. IMPAX actually built off a couple of decades of research they had done. They have a global women's leadership strategy that's managed in the US. So we actually have a history of quantifying behavior. So for this tool, essentially what we've done is broaden that out to get what we think is a measure of corporate culture. By no means the perfect measure. I don't think you can perfectly quantify culture, but I think this gives us a really good starting point. If you think about corporate culture, it's really about shared attitudes and values and standards and practices that shape a work environment. It's not, in our opinion, some well-written mission statement or some list of values, but it's really how a company does what it does for its employees, both in terms of informal behavior and informal systems. The question becomes, as an outsider, how do you possibly tell whether or not a company has a good corporate culture? So what we did to develop this was essentially evaluate all available social data. I think encouragingly, there's a lot more out there. We neutralize for things like market cap and for region, because a small cap company in Japan probably looks quite different than a mega cap company in Europe, for example. We wanted to make sure that we were comparing apples to apples. And then we identified those factors that were most predictive of alpha generation. So things like turnover, for example, percentage of women in management. And I think what is really interesting about it is I think we all intuitively know that when you have a great corporate culture, it leads to success over the long term, where you have motivated and productive workers, you have diverse influences on decision making, you have higher levels of productivity potentially, better relationships with customers and suppliers. When you have a poor corporate culture, maybe you've all worked for some company that has poor corporate culture, but you have higher turnover, you have demotivated employees, you might have bad relationships or unethical behavior. All of that over time, we think is quite detrimental to a company's financial performance. So the idea that we can actually now quantify the alpha generation from companies showing indications of strong corporate culture becomes an incredibly important tool in terms of screening in those companies that are showing indications of strong corporate culture, and also avoiding those that are showing really strong indications of potentially poor corporate culture. So we use that as part of our process to really screen down our universe and use that as a tool to help us in alpha generation over time.
Exactly. And alpha generation as in outperforming the index and peers, of course.
Exactly.
And I just love having these conversations because, again, there's such a big misconception that you're just giving up returns when you're looking at sustainability factors or like things like corporate culture. And the whole study was around where are the alpha drivers, where can we find these factors and outperform? So I just love that this perspective is shown through our conversation. Great. You're a portfolio manager and cover individual stocks as well. And those are in the consumer discretionary and consumer staples sectors. In these areas, where do you see opportunities and notable trends?
Yeah, I think there's a lot of really interesting trends in the consumer space. One around demographics being key to how we're thinking about consumer stocks in the portfolio. What we see are demographic shifts, particularly around things like nutrition, where you have younger generations, Gen Z and millennials, really looking for more nutritious foods. That kind of moves us away from those big food companies with heavily processed foods. We also see rising income in emerging markets. So what we see there are opportunities to invest in really affordable, nutritious foods. So a lot of really interesting companies companies we found around that theme. One of the areas that we found really interesting has been the growth of e-commerce. What we're looking to do within this social strategy is look at the democratization of technological transition. So things like e-commerce. So we hold companies that are in emerging markets, for example, that have a large third-party base. So meaning you have small families and small businesses being able to sell their products, really get access to millions of potential buyers through a really an affordable platform that they wouldn't otherwise be able to gain that exposure to e-commerce with. So I think that's really a trend that we continue to see growing. Rising income more in developing nations is key, Asia in particular. What we found is that as people start essentially moving to the middle class, one of the first things that they look to do is protect their wealth. So areas around insurance products, for example, become important in this strategy. So it's been really fun to think through some of these trends and then really translate that into companies' business models and which are positively affected by these trends.
Wonderful. The fund that you manage is the Global Social Leaders Fund. And as you've already talked about, you invest both in the US and globally and emerging markets. So the fund, I saw that it owns about 40 to 50 companies. And I wanted to ask you about what type of mindset do you need when investing globally, but also in a small number of names? It's a concentrated portfolio.
Yeah, it's really about having high levels of conviction. So you really want to understand a company's business model, understand the industry in which they operate. That works for regions as well. You want to try to understand as best you can the region in which the company operates, because you essentially can't take a US or European mindset to emerging markets, for example, and think that everything operates exactly the same. So it becomes certainly an opportunity to learn a lot about a lot of different industries and a lot of different regions, but really looking for companies that we think have strong competitive advantages, but not only competitive advantages today, but really the ability to maintain or grow those competitive advantages over time. That calls for just understanding the industries incredibly well. And once you do a lot of that work, you gain a higher level of conviction on the individual company and then more broadly on the portfolio and the broad exposures you have across the portfolio. So that's really how we're building it. I think some of the areas that are important to consider are from a risk perspective. You might love the growth opportunities in Latin America, for example, but you have to recognize when you have cluster risks in the portfolio and make sure that any bets that you're placing in the portfolio, whether that be on the theme or region, align with your conviction levels.
Great. So if I were to summarize, you have to understand the regions and countries. You have to understand the business models, do your homework, of course, and manage risk in order to succeed.
It's a lot to do, but it's a lot of fun.
It is. And you mentioned emerging markets. You mentioned Latin America as well. If you just look at the emerging markets part of the portfolio, and again, for the listeners who don't know some of the countries within that, where would you say you're most active in?
I think there's two regions that we think are really interesting. So Latin America being one where we have exposure to both the growth of fintech as well as e-commerce. The other being Asia, particularly within financials. So insurance providers, on that idea that when you have rising incomes, people start to protect their wealth. So those are really the areas where we have a lot of exposure, some of it as well within nutrition. So we have a couple of food distributors which have a focus on affordable, nutritious foods. So it's pretty spread out right now with regards to our end market exposure. It's something that we're looking at from a risk perspective as well. We also own some exposure in India to kind of a company that's focused on rural banking, on the idea that there's a significant population underbanked in that region. The companies that really provide affordable financial systems should enable people to really benefit from the growth of the region. So we found a lot of interesting opportunities within emerging markets. I think one of the areas that we focus on has been playing that through more developed domiciled companies that have exposure to emerging markets, just from a portfolio and governance risk perspective. We find that's a little bit safer way to play it. So companies that are domiciled in Europe or the US, they just have a lot of end market exposure to emerging markets. But we are finding some, I think, very high quality companies that are domiciled in emerging markets, which we have in the portfolio today.
Makes sense. And that's another way to manage your risk, of course. Next, I wanted to ask you about index funds. And I've been talking to a lot of people outside the industry, and there is this misconception that, oh, just buy an index fund for everything. I think part of it is the appeal, of course, of index funds. The other part is a gap in education, which this is why I'm here for. But I wanted to hear directly from you in terms of index funds versus active funds in general in the sustainable space and your thoughts of like pros and cons with each.
On the pro side, they're easy, right? You have broad exposure to an entire index. Also on the pro side, there are a lot of active managers that actually underperform the index. So you're not betting on a manager essentially outperforming a benchmark. I think something like 85% of active managers actually underperform their benchmark on any given time frame, which is quite sizable. On the con side, though, I've always believed you need a valuation discipline in this industry. So buying stocks like Tesla today, for example, where the valuation is tough to justify, I don't believe that over time leads to strong financial returns. So really thinking about not only the companies that you want to hold, but are they trading at a discount to what they're worth? On sustainable index funds, so much of what they do in defining sustainability is related on disclosure. So what you end up with is companies that have a tremendous amount of disclosure, whether or not that's material disclosure or not, become included in those indices, whereas you might have great companies that don't have a lot of disclosure, but are doing the right things that don't end up in those indices because it becomes something of a systematic approach to deciding whether or not a company is sustainable. There are opportunities for index funds to play a role in people's portfolio, and quite frankly, they should. But I think that people need to be aware that there are some cons to those as well, and you might not be getting the exposure that you want. And a lot of these sustainable funds include companies like ExxonMobil, for example, which from a product perspective is quite negative to the environment, but they do a great job on disclosure, and their people are essentially happy where they are. So they have a lot of social disclosure and gender diversity, for example. And that's the other thing with index funds. They don't consider the product of the companies. So you might have companies that have very negative products that are included in those indices.
That's fascinating. Actually, I didn't realize that it could be like a quantity versus quality mismatch over there, and that the index funds could have more exposure to those that just disclose more versus to what the disclosure is actually about. That's really interesting. But in the grand scheme of things, of course, for the markets to function, you need the active management. You need the portfolio managers to do the discovery. Not everything is known and disclosed and on paper yet, but it's an interesting observation. Thank you for sharing that. And then that leads us to the next misconception about sustainable investing among retail investors, where their automatic assumption is, oh, I give up returns by investing sustainably. So how should investors reframe their mindset around that mentality of I'm making a decision between return and sustainability?
Yeah, that's something that's come up more recently with regards to the trade-off. Sustainable investing firms had a very strong period of time and more recently have struggled a little bit with regards to performance, just speaking quite broadly. If you look at it again from an ownership mentality, it's really about the types of companies that you want to hold for the next 5+ years. Really, those are companies that are products and services that will experience economic tailwinds as the world moves to become more sustainable. Really, it's about great management teams. It's about companies that are thinking about their longer term risks and opportunities, positioning the companies to address them. That really speaks to a kind of a sustainability overlay. And for us, it's an enhanced due diligence process. It really helps us better understand the company and better understand the management teams and their longer term objectives. So I've never really subscribed to the idea that there's any sort of trade-off. In fact, I think it's positively linked when you invest in sustainable companies. But I think your time frame has to be not necessarily the outperformance on a quarter, but the outperformance on a market cycle. So a 3 to 5 year basis is what you're looking to do. And I strongly believe sustainable firms will outperform over the long term. But of course, you're going to have periods of time where they underperform, like we've seen fairly recently.
And that was the calendar year 2024 so far?
2024, and I think 2023 was a bit of a challenge. We had a rally in energy stocks. You had a rally in a bit lower quality companies as well. And I think ESG really, if you integrate it into your fundamental analysis, what it does is typically lend a quality bias to the portfolio from just companies with consistency, with strong track records, with good management teams. So I think if you look at factors over time, really the only factor you'd want a consistent exposure to over a 5 or 10 year period has been quality. You have growth that does well sometimes and value does well sometimes, but quality typically outperforms over the long term. And I think that makes a lot of sense. So where ESG lends itself to a quality bias in portfolios, that typically, in our opinion, leads to strong outperformance over time. But again, a given year could be quite negative for quality or sustainable.
Exactly. Year over year, anything can happen. And as you said, anytime there's a rally in energy, almost mathematically sustainable strategies might fall a bit behind for that period of time. So what are other ways to measure sustainable products performance beyond the returns then?
I think a lot of firms have impact reports out there. That's something that a lot of funds will put out, particularly sustainability focused funds. You have your returns, and you also have often a report on the impact of the companies that you're investing in and the positive impact they've had either on the environment or on society. So that can be measured in things like if you have an energy efficiency company in the portfolio, the tons of greenhouse gases that are reduced as a result of decreases in energy from their products. So it's really thinking about the products and the services that these companies provide and how they're having an impact on the world and how we can measure that. And I think one of the key things it's important to put in an impact report is transparency. So you really want to explain how you're measuring these. You also want to make it clear that these are results of the company's products and services. They're not necessarily a result of the fund or anything that they're doing specifically. But if you have an intentionality around impact, you're investing in companies that have products and services that actually benefit the environment and society. So these impact reports can show you the impact these companies are having per $1 million invested, for example, by end investors as a result of the products and services that they have.
Wonderful. So you manage a global fund, and global benchmarks typically have anywhere between 60 and 70% weight to the US. That would be the allocation of the portfolio in the US stock market. With the run in US stocks and the valuation spread between US and non-US companies at an all-time high, can you share with us how you are positioned and where you find the most opportunities?
Yeah, as we benchmark our performance against the MSCI All Country World Index, which is about a 70% weight now in the US. We actually have a bit of an overweight, if you look at it from a country of domicile perspective, to Europe, and a bit of an underweight to the US. And to the valuation point, that's really just a function of where we're finding better valued opportunities today. I think the US has outperformed international markets something like 20 years and counting. So we're just finding better valued opportunities outside the US. If you look at the companies that we're investing in, they're very global with regards to their products, however. So we're investing in a European company that derives a significant portion of revenues to the US, for example. And that's really how we think is a better way to understand risk. We've actually set parameters around how different we want to be from the benchmark, meaning we don't want to be significantly different. And that really comes from the idea that where we're adding value is on the stock selection, not on this macro call in terms of what region we think is going to do better or worse than the other. So we're finding a lot of great companies in the US. It's still a bulk of the allocation, but we are underweight relative to our benchmark, the MSCI All Country World Index.
And for our listeners, by not taking big bets against the geographic allocations, not simply as to where the countries are based, but where the revenues are coming from, you are allowing yourself to bring most of the risk and opportunity in the fund through the stock selection, the stocks that you pick. Is that correct?
Exactly. It's how we're monitoring and measuring risk relative to the benchmark.
Wonderful. Thank you. So I want to switch gears a little bit. You are one of the 15% of mutual funds in the US that has at least one female portfolio manager. And we're here in this podcast to highlight amazing top professional investors like yourself. But my question to you is, what can be done to promote more women in leadership roles within the asset management industry?
Yeah, that's a crazy statistic to me. It's so surprising to me there aren't more women in this industry. I just found it to be a great career. I think what we need to do is send the elevator back down, essentially really make the opportunity accessible for other women. And maybe that's mentoring people. When I was at Morova, we had a summer internship program where we'd bring in women for the summer who had an interest in finance and kind of help mold them and shape their career going forward. And I was able to work with some really amazing and incredibly smart women doing that. We have to help where we can and make it clear that this is an opportunity for women and send that elevator back down so that they can rise to the top as well.
Wonderful. And from my perspective, I think female role models, so like investors that we've never heard of, there's so little media coverage. And that's a big part of what I want to change with this podcast is there are some amazing women like yourself in this industry with long experience and success that we need to all see, hear from, and learn from, and get inspired from. We're all doing what we can.
Exactly. I think that's all we can do. But yeah, no, it's great you're doing this podcast.
And I want to ask you, so as you progress more in your career, did you feel like you were becoming more and more comfortable taking investment risk without implying that you are actually taking massive risks in the fund? It's more of the progression of your comfort with the risk taking. Can you tell us a little bit more about that?
Yeah, I would agree with that. I think this is an industry that benefits from experience. And I think as you start to gain experience, you try to understand the risks that you're taking a lot better. You tend to really cement your conviction and feel more comfortable taking those risks. But that being said, I think if you look at this industry, there has to be that balance between confidence and humility. So you're not always going to be right. And it's something that has taken me a while to learn, but it's really recognizing when you're right and the market has it wrong. And when you're wrong and you need to admit it, they'll move on and learn from your mistake. That's a challenging balance for sure. And I still don't always get it right, but I'm better than I used to be for sure. So it's really making sure that when you're taking risks, you have a tremendous amount of conviction. I think your comfort level definitely grows with experience over time.
Great. So what advice would you give to young women considering a career in finance?
Yeah, I say go for it. It's been a great career. There's so much to learn. That's what I love so much about this industry. I can spend a day or weeks learning about things like the sneaker industry to invest in a company, and the next day learning about food in Mexico. It's always fascinating. It's always humbling. Can you feel great about yourself one day and the next day being incredibly humbled by some stock? And I just love that about this industry. So I would say go for it. I think in terms of just advice in general, someone told me that a long time ago, and I've tried to follow it. Work hard, stay humble, and be kind. There's a lot of people out there who I think are willing to help women who want to get into finance. So I'm just asking for informational interviews, asking someone to sit down for a cup of coffee and share their experience and any advice they have. Maybe they have an opportunity for you, but maybe they don't. And you can just learn something just talking to them and how they got to where they are. I also think be willing to start out at a firm that you want to work at, even if it's not the ideal job. When I graduated from business school, it was a challenging environment. I had no experience in finance. So I ended up working at a hedge fund covering airline stocks, which was a challenging job to begin with. But I took the job as an intern and they gave me a 6-month trial period and it ended up working out. But I think you're not always going to graduate and land exactly where you want to land. So maybe start out somewhere that you want to work, use that opportunity to learn about the company and potentially move around in that role to something that you want to be doing over the longer term. I think of a career as a bit of a chess game where you're not just thinking about the next move, you're thinking 3 moves ahead. And so I think that becomes important to think about it. Maybe it's not a straight line, it's a bit of a zigzag, but it gets you to where you want to be. And then finally, be persistent with the caveat that you don't want to be annoying. But I remember in between my 2 years at business school, I basically took the book of every alumni from Boston College and started calling everybody within finance. And I talked to someone at Morgan Stanley who said, maybe he has a job, maybe he doesn't. Why don't I give him a call another week? And that lasted for 2 months. I kept calling for 2 months. And I finally got that summer internship with him. But I had to be very persistent to get it. Have to be a little bit willing to be flexible, to network, and to be persistent when you can be. And those are always things that I think people should be following with regards to not only their career, but their life. That would be my advice as well.
Great. Thank you for sharing. Okay. And last question. Most of the women that I meet outside the industry are greatly interested in sustainable investing, but don't really know where to begin. What would you say are your top 3 tips to get started with sustainable investing?
In terms of people thinking about investing in sustainable investment strategies, maybe start out by reading the prospectus of the fund, understanding their process and whether that makes sense to you. You can look at the holdings of certain funds, at least their top 10, and see if those companies make sense to you. I think performance is something that people should be considering as well. I think people tend to invest as funds have done quite well. They often invest at the top. Whereas I think if you can find a good manager, the best opportunity is to invest with them after they underperformed. So really understanding that longer term track record and understanding that every manager is going to go through a bit of a struggle. I think that becomes important to consider when you're looking at timing of investing in a strategy. And I think there's a lot online with regards to sustainable investing, not all of it positive, but I think just understanding what it's meant to do and then finding a manager that really integrates it in a way that you think is logical from a performance standpoint over time.
Great. And I would love to add to that to not overemphasize performance and some short-term underperformance over 1 or 2 year periods is actually a great entry point if the long-term track record is still attractive. Great insight. Thank you. And that's a wrap. Amber, thank you so much for joining us on the podcast and for the wonderful insights into sustainable investing that you shared with us.
Absolutely. It's my pleasure. Thank you.
And thank you all for listening to the Investing in Other Stories podcast. If you enjoyed this content, please take a moment to subscribe to and rate the podcast on Apple, Spotify, or wherever you get your podcasts. You can follow me, Margarita Tr on LinkedIn, or at Finance Latte on Instagram, and Amber Fairbanks on LinkedIn. Cheers, and see you next time. The information provided on this podcast is for informational purposes only and should not be considered investment advice. The opinions expressed on this podcast are as of the day of the recording and are subject to change without notice. The views and opinions of guests on this podcast are not necessarily those of Finance Latte AB or its host Margarita Tr, collectively referred to as Finance Latte. Finance Latte is not affiliated with its guests or their affiliates unless otherwise stated. Finance Latte does not guarantee the accuracy or the completeness of the data presented herein. The information on this podcast is for informational purposes only, and the information, data, analysis, and opinions it includes should not be considered investment advice or tax advice, and is therefore not an offer to buy or sell a security. Finance Latte AB is not responsible for damages or other losses resulting from or related to the information, data, analysis, or opinions in the recording. Past performance does not guarantee future results. All investments are subject to investment risk, including loss of principal. Individuals should consider their own unique needs and circumstances and objectives before making investment decisions. Please consult with a tax or financial advisor for advice specific to your individual circumstances.